Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another edition of the Blue Chip Partners Quarterly Edge. I'm Daniel Dusina, Chief Investment Officer.
And I'm Dan Seder, Managing Partner.
So, just as usual, I've got Dan in here to ask me a couple of questions about my outlook for the next few months and beyond.
All right, Daniel, let's start with the economy. There's a lot of talk about the economy and where the economy is heading. Talk to us about the labor market, talk to us about the consumer, and talk to us about inflation.
Sure. I'd say those are the headline points, but overall, the U.S. economy has exhibited a very surprising amount of resilience. So, second quarter GDP, economic growth in the U.S., actually was just revised upwards to 3.8% annualized. It's a pretty strong number. Now, a couple of interesting points about that to note. We've seen artificial intelligence related investment be a very large piece of that puzzle. You kind of have to dig through the weeds of the data to figure out that statistic a little bit, but take my word for it, we're starting to see some serious momentum there, which I think is a very positive sign and also a trend that I think we can see continue. The tariff-related impacts to GDP, I think, have been more or less on the margin and also should not be taken as anything more than one-time effects. So overall, to see a plus 3.8% economic growth figure on an annualized basis, I think that just points to continued resilience through the economy overall. Now, one interesting note on the downside, I would say, is the labor market. So there has been a lot made of recent downward revisions to job additions, both month to month this year, and then some revisions to the negative side that were made to last year. I don't think there's anything to panic about here, but there's clear signs of labor market softness that are emerging. Last quarter, we talked a little bit about how it's no longer being very beneficial for people to continue to switch jobs because they're not making any more than anyone that stays in their job year over year. I think that continues to be reflective of both caution from employers who are approaching the uncertainties that we have with related foreign policy items, as well as individuals who are just not too sure what to do with themselves, as we've had a very strong economic backdrop and a very strong financial market backdrop as well.
But that's not impacting the consumer.
It's not. Okay. Realistically, the consumer continues to be incredibly strong and the primary growth engine for the U.S. economy. It should be no surprise that as goes the consumer, so goes the U.S. economy, as the consumer is roughly 70% of GDP. But I can point back to any of the number of figures or the readings we've gotten on the consumer throughout the previous quarter, whether it's retail sales or stripping out the consumer spending from GDP. All signs have pointed to the fact that A, consumers continue to have very strong household balance sheets, and B, they have a willingness to spend. Those balance sheets, you can reference something like U.S. credit card delinquencies. So what I'm showing on the screen right now is the overall credit card loan delinquency rate from all U.S. commercial banks. And not only are we seeing it at reasonable levels relative to history, we're actually seeing it decline. So after peaking in, call it, the end of 2023, we're seeing consumers in better positioning financially, at least as would be implied by delinquency rates heading lower, than we've seen at any point in the last couple of years.
Yeah, and I wonder if that has something to do with the wealth effect. As markets have really rallied, I think that has a big impact on areas like consumer spending and credit card debt.
Yeah, I mean, I would tend to agree with you. You know, something we called out at the very beginning of this year with regards to why can the consumer continue to spend, it's because after a couple of years of serious market appreciation, individuals feel good. So not only are they able to spend because they have good balance sheets, but they're willing to spend because of some of that psychological impact.
Yep. And so is inflation under control?
I would say yes and no. I mean, overall, there's not major concerns with the inflation picture. What I would say, and the Fed has called this out, is that you very likely will see some one-time impacts from some of the tariff-related measures. We have seen inflation tick up moderately over the past few months. All that said, you still have a Federal Reserve that is cutting rates. So usually when you look at the Federal Reserve, they have this dual mandate that is regarding maintain full employment and a reasonable level of inflation. The reason that they're starting to reduce interest rates right now is because they are putting much more focus on the declines we're seeing in the labor market.
Right.
It's not that they're not paying attention to inflation, but they have put much more of an emphasis on addressing the concerns in the labor market. The reason that I think this is important is because if you start to cut rates and you make financial conditions a little bit easier and you have a strong consumer, that could tell you that if you get this wrong and you soften too much, then you can have a risk of elevating inflation.
Yeah.
So that's where I would say the bottom line right now is the economic backdrop remains very solid and the economy's been resilient overall, but you have to watch inflation because if we get Fed rate cuts start to be reflective in higher inflation, I think that's just a concern that bears some consideration over the next, call it 3 to 6 months.
Got it. Okay. Let's shift to the markets. We talked about this big run in stocks. There's concerns about valuations. So let's touch on valuations and let's touch on opportunities. What opportunities are you seeing in the market today?
Yeah, well, I think it's really interesting because anytime you have a significant run up in stocks, the immediate question is, why would I invest now? Are stocks overvalued?
Did I miss the run?
Exactly. And so I think perspective is very important here. So specifically speaking to the S&P 500 index, that's a capitalization weighted index, which means a higher weight in that index is afforded to the largest companies. The largest companies, at least by and large, tend to fall in the tech and related sectors. So if you have a high valuation for the tech sector, so goes the S&P 500 index. Yeah. So what I'm going to show on the screen right now is essentially a graph that is inclusive of the S&P 500 index, the S&P 500 equal weighted index, which doesn't have that same mechanism that the cap weighted version does. It just gives an equal weighting to each company in the index, and then the equal weighted S&P sectors. Along the bottom, you have just trailing price to earnings ratio. So how much is an investor paying per share relative to the level of earnings? And along the left side, the y-axis, I have where those sectors and indexes are relative to their 10-year average price to earnings ratio. So to simplify this a lot more than that long-winded description I just gave, in the lower left quadrant, you have sectors that are cheap versus other sectors and are also cheap relative to their 10-year average. In the upper right quadrant, highlighted in red, you have sectors and indexes that are not just expensive relative to other sectors, but are expensive relative to their 10-year history. So to see information technology in the S&P 500 in that expensive zone, it's not surprising. That doesn't necessarily mean that it's a market top or anything like that, but what I would call any investor's attention to is the fact that the market, as I see it, is better represented by the S&P 500 equal weighted index, giving an equal amount of credit to each individual company. And that's actually bang on its 10-year average price to earnings ratio.
Which is roughly
18 and a half or
18
so.
18 and a half, okay.
Right. And so as you look at sectors like consumer discretionary, even though in the cap-weighted S&P, consumer discretionary might be dominated by Amazon and might look overvalued, on an equal weighted basis, it's actually undervalued relative to its 10-year trailing price to earnings ratio. Same thing with healthcare. Healthcare has been one of the sectors that has struggled more or less this year. You're seeing it trade relatively cheap versus other sectors and relatively cheap versus its own history. So I do think the misnomer that the market is outright expensive after a run-up is a bit misguided. I think you do have to be selective at this juncture because more likely than not, after a very strong V-shaped recovery post some volatility in April, you've had a nice run.
And when you talk about being selective, that's as opposed to investing in the index. That's opposed to just being a passive ETF or index owner, actually being selective in which stocks within each sector you're going to buy.
Right. And I think it's important because of, I'll tie it back to some of the economic comments I made. Overall, the backdrop is very constructive, but because we have those key variables around labor and inflation, I think there's going to be some choppiness, or at least periods of choppiness as we look out over the next 6 months. A significant run, some uncertainty on foreign policy, and some domestic uncertainty around labor and inflation. That to me points to I don't necessarily feel compelled to overload myself from a risk perspective from a passive index. I want to be selective and pick up good businesses that have fallen behind, perhaps unnecessarily so.
Yep, got it. Okay, great. Let's talk about money markets. So the level of cash that's in money market positions today and what the changing dynamic in the interest rate environment means for the money market opportunity.
Yeah. So, as we referenced before, the Federal Reserve has more or less re-embarked on an interest rate cutting cycle. So the Federal Reserve will start to cut interest rates in order to stimulate or preempt some weakness in the economy and make borrowing conditions, financial conditions overall easier. There are secondary effects to lower interest rates. The one in particular that I'll focus on is money market funds. So the Federal Reserve can control very short-term rates. And one thing that is fairly correlated with short-term rates is the yield that money market funds offer. So over the last couple of years, money markets have become very attractive to investors as a borderline risk-free, but not necessarily risk-free asset. Technically, we can't call them risk-free, but they're as close to it as you can get. So to be able to clip 4.5%, close to 5% on a almost risk-free asset has been really attractive to investors, especially retail investors, where the usage of money market funds has more than doubled over the last 3 years. Now, the changing dynamic stems from the Federal Reserve starting to cut interest rates. So as the Fed starts to cut rates, money market fund yields go down. I think cash starts to get curious. So investors that have allocated to money market funds as a cash proxy, I think they're going to start to get curious. If you've been following us, you'll recall I've been saying this for the last couple of years, and I clearly was a little bit early on that because your retail usage of money market funds are close to $3 trillion, a record high. So what do I actually think the catalyst will be for retail investors to move money away from money market funds? As I sat back and thought about it more at a high level, I think it's actually just simple psychology. I think that once you get the Fed cutting to a degree that would make money market fund yields start with a 3 handle instead of 4 on the percentage sign, I think that's when retail investors start to get curious and look elsewhere for their cash.
Yeah, and I'll pair that with another behavioral bias, which is fear of missing out. So I think a declining interest rate environment, lower yields on money markets, and being in a money market position for the last couple of years as the stock market has absolutely boomed is going to be a great pairing for additional fuel into stocks as rates come down.
Yeah, and I think that's
stocks
well
and
said.
bonds.
Exactly.
Stocks and bonds.
Well, and I think it pairs well with the fact from before where it's our U.S. stocks overvalued. I don't think so. I think you have to be selective. But the point I'm trying to make, too, with these money market fund assets, as you see those start to get reallocated, I don't want to say it necessarily puts a floor under the stock market in the U.S. and the bond market in the U.S., I think it actually can help lift stocks and bonds as cash gets reallocated.
No doubt.
So I think as you start to see money market fund yields approach a 3 handle, I think that's going to start to get really, really interesting.
Awesome. Daniel, we talked the economy, we talked stocks, we talked money markets. Anything else?
Nothing else.
All right.
Pay attention and stay aware because as we round out this tumultuous year, I think there's still going to be a lot of information flow that can have potential to move markets.
Buckle up.
Thanks for joining us for another edition of the Blue Chip Partners Quarterly Edge. We look forward to speaking with you again next time.